Sometimes when a company engages in aggressive revenue recognition, it's just prematurely recognizing revenue that would have been recognized in the next year anyways, and they're just trying to recognize it in the current period. However, sometimes aggressive revenue recognition is just completely bogus sales or some situation where revenue should by all rights not be recognized either right now or in a future period at all. For example, if you have a company that ships product to a customer that the customer did not even order, and you say, well, why would a company even do this? Well, let's say you ship the product to the customer. So here's the customer C. Now, what you have is you have shipping documents that you can show your external auditor, hey, look, we made a $10 million sale, and look, here's the shipping documents. We sent it to the customer. Then you might say, well, hey, wait a minute. This customer is just going to send this right back. Well, think about it. The customer's probably going to think this is a mistake. They're going to contact you and say, hey, we just got $10 million of product, and we didn't order this. And you say, okay, well, just send it back. You know, mistakes happen. But when you receive it back, it's the next quarter. So you book that $10 million of sales for the current quarter, and the customer just thinks it's a mistake. Oh, yeah, companies are sneaky like that. Now, shipping empty boxes to customers, that's actually happened. If you think this is crazy, what company would ever do that? There's a company called American Banknote Holographics, and they were shipping empty boxes to customers. Basically, the customers were getting upset, actually saying, hey, we get these boxes, and they're just like either completely empty or scraps. So they basically made holograms and stuff for money to help the governments create currency. And they were shipping empty boxes and sometimes boxes with just scrap materials to the customers. And just obviously it's very sketchy when the customer is receiving that and stuff. But again, what are they trying to do? They're trying to create some kind of paper trail. So when the external auditor comes in and does their audit, they can say, hey, look, we have shipping documents here. We actually shipped out boxes to the customers. But of course, the customers are going to be unhappy. They're like, look, you're actually literally sending us garbage. Please stop. But these have actually happened, these crazy scenarios. Now, relaxing the credit policy, you might think, okay, well, maybe that's just good business. Well, when it goes to its extreme, when you're giving credit to people who you know are not going to be able to pay, or there's extremely high risk, these people are not going to be able to pay. For example, there used to be a retailer called Grants. Okay, and Grants, the business was declining, and they basically started giving out credit to anybody with a heartbeat. Okay, so you had Grants, they were giving out credit, and then also there was a jewelry store called Friedman's. Okay, that sold jewelry targeting low-income consumers, and they basically significantly relaxed their credit policy, and they weren't recognizing sufficient bad debt to basically acknowledge that, hey, most of these people aren't going to pay. And so those are a couple examples where the company's trying to boost sales. Remember, the company wants to increase revenue, right? So they want to increase revenue, and sometimes they will engage in behavior like just giving credit to anybody. That'll increase sales, right? If you run an ad and you say, listen, you walk in here, no money down, not going to check your credit, doesn't matter. You walk out of here with a washer and dryer that day. You want that deal? People will be like, yeah, I'll take that, right? You're increasing revenue, but is that really a sale? Now, when you recognize revenue when a product has been consigned, that is not right. That is not right. So here's what consignment is, by the way. So let's say you have a product and you haven't sold it to a customer. You shipped it to what's called a consignment company. Okay, so I'll just put C-O-N-S here. So a consignment company, and they're called the consignee, technically. Okay, so you send it to the consignee. The consignee is going to sell it, and then they're going to get a portion of the proceeds. So if they sell it for $100, they might keep $30 of that, and you get the $70. So basically, this product, when you send it to the consignment company, it is not yet sold. It's still your property. It's just the consignment company is holding it and trying to sell it. So you can't recognize any revenue just because you gave it to the consignment company. Sometimes companies improperly do. They say, hey, look, we sent it out. It's gone. It's a sale. And it's like, no, it's not. Now, bill and hold sales, you should always, if you ever hear about a company with bill and hold sales, you should assume they're sketchy. So there are limited cases in which a company can legitimately recognize a bill and hold sale, but usually when you hear bill and hold, just think that this is sketchy. Bill and hold is, hey, we've got a sale where the customer wants this product, and it's a legit sale and everything, but they don't want the product yet. Maybe they don't have space for it, whatever. So we're going to bill them, and then we're just going to hold on to that inventory. So the inventory, remember, inventory is normally, the sale is recognized when you ship the product or the customer receives the product. If it's still sitting in your warehouse, generally you're not supposed to be recognizing a sale. So these bill and hold sales, like there was a company called Sunbeam. Okay, they were involved in a huge accounting fraud, and one of the things they did was bill and hold sales. They basically, it's like it's not a real sale. Imagine if the warehouse burned down, and you go to the customer and you say, "All right, you got to pay for all that," and they're like, "I'm not paying for that. I never even received it." Right? So that's why bill and hold sales are a little bit sketchy. Now, recognizing revenue on sales of non-existent inventory, that is harder to do than you might think, because you not only have to fabricate a sale, you also have to fabricate that there was any inventory to begin with. And there have been plenty of companies, though, that have overstated and basically made up inventory that they did not have, like Farmore, for example. They had a big accounting fraud and went bankrupt and went under. So, you basically make up that you even have any inventory, and then you make up a fake sale. So you got fake inventory and a fake sale to go with it. Recognizing revenue when there's no commercial substance. Commercial substance, I'm talking about, like, there's really no economics happening here. For example, let's say I make video games. Okay, so I make video games, and I say, okay, I'm going to sell 1 million units to this distributor. Okay, to the distributor, I'm going to sell them 1 million games, but I have a side agreement with them. Okay, I have a side agreement with them where they're immediately going to buy 1 million games, or I'm going to buy those 1 million games back. So I have, quote, sold the 1 million games to the distributor. I have the sale, but I have a side agreement, which maybe I don't disclose, right? I don't put that out there in my 10K or let the auditors know about it, which is wrong, as I've said. Now that I'm going to immediately buy this back. Okay, so that, if you're booking a sale, you don't have a sale because you already have a side agreement to buy the inventory right back. So that's sketchy. You've had companies that, like, they set up like a subsidiary and stuff, and the subsidiary, they're like making the sale, but then it's going to come right back with some kind of side agreement. So anytime you hear about undisclosed side agreements or, some kind of transaction where you're like, is there any commercial substance? Is this a real sale? You should not, you should be very skeptical of that company's accounting. Grossing up revenue, in some cases, is a lot. So what I'm talking about with grossing up revenue, you've got like these online booking companies, okay, where you like book a hotel through them or something. And let's say that you end up paying them, let's say that you pay them $103, okay, for a night at a hotel. You pay them $103, but they're only getting, their revenue is really only $3. Okay, 100 of that is for the hotel. They only just take a $3 fee. So really, if you think about it economically, their revenue is $3, right? They made a $3 fee from that transaction. But what some of them will do is they'll recognize $103 of revenue and then subtract the 100 as cost of sales. So basically, this doesn't affect profitability. Is you got 103 minus 100 or just recognizing 3. Either way, it's 3. So you'd say, well, why does it matter? Well, when they do it this way, then the top line revenue is going to be a lot larger. So it's making it look like, wow, look at all this revenue they had. And it's like, come on, really they collected a $3 fee. That's what happened here. Now, Boomerang transactions. So I'll give an example of actual Boomerang transaction. So there's this company called Global Crossing. Okay, they basically built a transatlantic fiber optic cable and stuff for internet traffic and other things. So they had this transatlantic cable, and they, among other things, they got into these Boomerang transactions with companies like Quest. Okay, and what they would say is, look, hey, we need to buy some capacity from you, Quest. We need to buy some capacity, so we'll pay you $100 million. Okay, we'll pay you $100 million for some capacity. And then Quest also is like, hey, well, you know what? It's a coincidence. We need $100 million of capacity from Global Crossing. So they each are saying they need $100 million of capacity. Now, the question is, are they really buying capacity from each other? And this comes back to whether there's commercial substance. Okay, this comes back to whether there's commercial substance here. This is really a transaction that may not have commercial substance. If you could show, look, no, actually they really needed 100 million capacity and so did Quest, and this is a legitimate transaction. But what happened? Here's what Global Crossing did. So they recognized $100 million of revenue from this. They say, oh, look, Quest gave us $100 million of revenue. But when it came to the amount that they paid Quest, what they did was they capitalized that. Okay, so they made it an asset and depreciated it over time. So I don't know how many years they spread it over, but let's say they spread the $100 million over 25 years. Okay, let's say they spread it over 25 years. So then in the first year of the agreement, they have booked $100 million of revenue right now, but then they only take $4 million of expense right now. So in the current period, they recognized $96 million of profit, when in reality, it's like, look, this was a capacity swap. You got $100 million, they got $100 million, and maybe there was a legitimate capacity swap, but you shouldn't be accounting for it like this, right? You're booking the 100. You're treating the revenue side of the transaction where you're booking all right now, but then the expense side of the transaction you're spreading over 25 years, and that was not good accounting.